Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 36. Well, that was a weird week in the market, just a roller coaster of a week. We have Russia invading the Ukraine. The markets obviously had a strong reaction to that. It's also one of my favorite Saturdays of the year. We have the Berkshire Hathaway annual report coming out, so we get to hear from the man himself, Warren Buffett, so we'll discuss that. We'll also discuss the strategies that we've talked about before, but we just kind of need a reminder of how do you invest in this kind of market. So we're going to discuss that and much more. So without further ado, let's get to work. Well, welcome back to the program, everybody. I appreciate the opportunity to get to talk to you once again, and hopefully give you some investment lessons that you can apply in your life, and just kind of remind you of some of the things that are going to be important when we have these times of uncertainty, right? So this week you had Russia invade the Ukraine. The markets obviously reacting to that very, very strongly. And it was just a crazy week. It's a roller coaster of a week. Even though the markets rallied, for the most part, most of the indexes were actually down for the week. But it's pretty interesting. You have to remember, I have this conversation a lot with individuals, with other investors. And one of the things I have to remind them of and really remind myself of is how many people in the market are traders versus investors. So if you'll remember, investors are individuals who invest in a company for longer than 2 years. Traders is shorter than that, could be a day trader, month trader, whatever it is. And the thing about it is that in today's world, it's easy for you to trade, right? It's easy for you to go on your cell phone, whatever, computer, trade out of a position. And when you do that, the pain is essentially over, right? The pain of losing money is over. The problem with that is if you look at what happened to the market on Thursday, the Dow Jones was down 800 points when the market opened. And when the market closed, it was actually up 100. So that's a 900 point swing. And then on Friday, it was up another 800 points. And yes, it had fallen, and so it ends the week still down a little bit. But if you had sold out of your positions on Thursday morning, you are seriously throwing up in the trash can today, because you have lost a lot of money. And so I have to remind you that something we've discussed in the past is that, most of the best days in the stock market happen within the worst days, or happen within 2 weeks of the worst days. Sorry, kind of misspoke there. So most of the best days happen within 10 days or 2 weeks after the worst days. And so you can go look at charts that show this. Just go to Google and type in missing the best days in the stock market, and you're going to see a lot of charts that show that, like, if you miss the best 10 days over a 20-year period of time, think about that. The best 10 days over a 20-year period of time, so the best day every 2 years, you cut your performance from around 10% down to about 6%. And so what happens is you sell out Thursday morning and you miss the recovery Thursday, you miss the gain today, and you say, I'm going to buy back in on Monday. Well, that 3 to 4% that you just missed, that was it. That was the day. Those were the days. And so you can't recover that. And you do that enough over a 10, 20-year period of time, and you impact your performance, right? So we've talked about, and I've reminded you that the number one mistake that most investors make is trading their portfolios too often, right? But when we're panicking, when things are emotional, which right now things are very, very emotional. I mean, there are real people's lives being impacted right now, and it's hard not to be emotional. But you kind of have to separate, or you have to do your best to separate your intellectual mind from your emotional mind and not let yourself get carried away into making bad decisions. But this is also a time where you need to look at walking into the fire a little bit and saying, okay, man, things do not look good, but is there some value in the market that I can take advantage of, that I can look at saying, okay, what is something out there that I want to buy more of? Has it moved down? And so when you look at that, you don't have to buy, like we talked about, you don't have to buy all at once, right? You can break your purchase down. You can buy a couple shares. I can't even tell you, this week, how many clients I went in and bought 5 shares of this, 10 shares of this, just, good, solid companies. But if you were looking at buying Apple, the beginning of the week, it's at $70 a share, I think. At one point, I know I saw it at $159, right? So you look on, last Friday, it closed at $168. It got down to, actually got as low as $155 and finished the week at $165. So on Thursday morning, if you would have kind of walked into the fire a little bit and bought 10 shares of Apple, you'd be up. Right. And of course, I mean, it's easy to say that because I can see that the chart, I can see that it recovered. But at 154, I'm willing to buy 5 shares or 10 shares. And let's say it keeps dropping, 145. I'm willing to buy another 5. I'm willing to buy another 10. Right. And so, and if you don't have time to sit there and watch it, which I realize that not everybody does, you need to familiarize yourself with what's called a limit sell. So a limit sell is when you go into your trading platform and you tell the computer, right, you put an order in, you say, I want to do a buy order. Most programs are going to be defaulted to a market order. So a market order means when you put the order in, it's going to give you the best price it possibly can right then and there. But you could say a limit order. So you can hit the little drop down box, say, I want to buy 10 shares of Apple. I want to do a limit order. And then you put in a price. And let's say you put in a price of $156. Well, that basically tells the computer that you do not want to pay more than $156 for a share of Apple. And then if you hit on there, like it'll ask you how long you want the order to last. You can say, most of them say like GTC, which is good till canceled, which will last for 6 months. You can say GTD, which is good till the end of the day. And so you can use these limit orders to say, okay, one way I'm going to try to make the best moves during this volatility is I'm going to put some orders in that I think are kind of crazy low. And who knows, I might, have these things trigger. And so it's nice because you can kind of think of this in more of an intellectual way instead of an emotional way. And you can say, okay, would I be okay owning Apple at $155 a share? Yes. And then if it triggers, you could say, okay, well, maybe I want to buy another 5 at $145, right? But that limit order kind of takes the emotion out of it because you're going to have to do it when, maybe you can do it when the market's closed. You can do, whenever you want to do it. But I like to do limit orders when the market's closed and I don't have all the noise of everything going on around me. And I kind of look at it. I can say, okay, this is where I want to be able to pick up these shares. But that is a very, very easy way, effective way for you to kind of take advantage of some of the volatility and look at the companies that you really want to own and try to get them at a price that you want to own them at. Now, the thing about it is sometimes, the market will bring the price down very close. And if it doesn't hit that price, you're not going to get it. So like, let's say we'll go back to that example. We say, okay, I want to try to buy Apple, a limit order of 156. If Apple gets down to 156 and 10 cents, it's not going to fill. So that's kind of the bad thing is you can be pretty close to it and still not get it. So, but it is much better than just, feeling like you're missing out. But, you can try that out, and it becomes a very effective way of being able to buy shares at a better price, especially when you have the kind of volatility that we're currently having, and it's really out of the control of the market because there are so many geopolitical tensions that are impacting what we're seeing on a daily basis. And so if you're a long-term investor, you should, it's not that you should welcome the volatility, but you should really be looking at it saying, okay, how can I potentially take advantage of this? And like with my clients, I know I've done a good job of educating them, or I've done an okay job of educating them when these kind of days happen and they message me and say, okay, what are we going to buy today? And that's kind of how you should be thinking, right? I mean, look at the difference of prices between November and today. And I know a lot of you made lists, right, okay, what do I want my portfolio to look like? And this is kind of when you got to step into the fire a little bit and start making that happen. Because 3 years from now, 5 years from now, is it really going to have a long-term impact? And of course, you don't know, but you just have to, at some point, you got to bet on America that we're going to be able to figure it out and things are going to work out, right? I mean, at the end of the day, that's what we're doing. It's funny because as more people listen to this podcast, people message me, and somebody messaged me on Thursday and said, man, you better get those Radio Classic 1952 programs going. And I was like, man, I don't remember having that conversation with them. And then I realized that I had talked about that on the podcast and that they were listening to it. So it's kind of funny how that's been working out. So with that in mind, Warren Buffett, hero of mine, mentor of mine, somebody that I always looked to, came out with his annual report today. This really dropped like 3 hours ago. So I've been reading through it, looking at what his writing is. And so this is really just really kind of just a high level view. I haven't been able to look at it as detailed as I want, but I wanted to bring it up. So you can go to BerkshireHathaway.com, go to their website, look at their annual reports. You can download it and you can read the 10 pages that Warren Buffett wrote on on last year. And one of the things that I wanted to point out and read from you is he says, he's talking about the government and kind of the taxes that they pay. And he says, in fairness to our government partner, our shareholders should acknowledge, indeed trumpet the fact that Berkshire's prosperity has been fostered mightily because the company has operated in America. Our country would have done splendidly in the years since 1965 without Berkshire. Absent our American home, however, Berkshire would have never come close to becoming what it is today. When you see the flag, say thanks. And I do believe that is an important point, that if you're listening to this and you can invest in American companies and you can invest in America, you should be very, very thankful, because this does not happen everywhere. If you want to go look at what happened to Russia's stock market when they invaded Ukraine this week, I'll tell you right now, it dropped 50%. That is not a good day. A 50% drop in a nation's entire stock market is obviously something you do not want to see. So, you have to have gratitude and thanks that you are able to invest in a country that has had such prosperity for such a long period of time. And so he talks about, their biggest investments. Number 2 actually is Apple. And I thought this was interesting and wanted to bring it up because we have talked about this before. And he talks about how their ownership in Apple went from 5.39% to 5.55%. And that doesn't seem like a lot, but every 0.1% equals $100 million. So real money. And he says that they actually didn't put any more money into Apple. But the reason their ownership stake grew is because what we talked about last week, share buybacks. right? So Apple's share buybacks pushed up Berkshire Hathaway's ownership percentage because of that. And it made a huge difference in their performance. So the dividends alone were $785 million, but their share of Apple's earnings amounted to $5.6 billion because of the buybacks. And so it cannot be underappreciated or what share buybacks do for your performance as an investor. The hard part is that it's really not something that's easily measured when you go look at your cost, your cost basis when you're looking at your shares on a computer screen. It's one of those things where computers are smart, but they're not that smart, and they really don't know how to factor that in, if you will. Berkshire Hathaway also spent $27 billion buying their own stock back. So that's the one thing, if you don't understand the corporate structure of Berkshire Hathaway, they own some businesses outright, and then they own shares of businesses, right? So they own like Burlington Northern Santa Fe, they own the entire railroad. But a company like Apple, they just own so many shares. And Coca-Cola, that sort of thing. So you can look and see the main companies that they own. Let me find the sheet here. So the main companies that they own shares in where they don't own the entire company would be American Express, Apple, Bank of America, Chevron, Coca-Cola, General Motors, Moody's, U.S. Bank Corp, Verizon, and a little bit of others. But those are the main ones. So when those companies are buying their shares back, obviously Berkshire gets a boost. But then when Berkshire starts buying their own shares back, you kind of get a double boost. And so it's amazing to see the growth of that. You'll notice that when you go look up Berkshire Hathaway, there's two share counts. There's Berkshire Hathaway A shares and there's Berkshire Hathaway B shares. I'm guessing you're going to be more interested in the Berkshire Hathaway B shares because the A shares right now are trading for $481,000 a piece. That's not a misspeech. That's seriously $481,000 a piece. And so when you go back and look at that growth over the past, 30 years, it's pretty tremendous. But the Berkshire Hathaway B share is trading for $319. So that one is much more my speed, the $319 version. I am a shareholder in that personally, so full disclosure. Disclosure. I'm not your financial advisor. This podcast is for entertainment purposes only. Please consult your financial advisor before making any decisions, and past performance is not indicative of future results. So, again, the lesson today is that when you see all this chaos going on around the world, and it is scary, right? There's rumors of, what could potentially happen. Our thoughts kind of get away from us. We think about just, we extrapolate what could possibly happen, and it's easy to get nervous. But you do have to think about all of the bad things that have happened over the last 30, 40 years, and how have the markets reacted to that, and have they been able to recover? And so you can go look up what happened to the stock market and things like that when other wars have broken out. I was looking, even during World War II, from September 1st, 1939 to August 31st of 1945, the Dow Jones gained 50%, or roughly 7% a year. And then during the Vietnam War, the S&P gained 29% from March 1965 to 1973. So normally there is a little bit of chaos in the beginning, and then later on the markets stabilize. But when you look at Russia, Ukraine, you can kind of easily tell what sectors are going to be impacted, right? Obviously, oil and gas is going to be impacted, and that kind of has ripple effects. And one of the main ripple effects is that if gas goes up and consumers are paying more at the pump when they're filling up their cars, they're not going to have as much funds or money to be able to buy maybe things that we consider luxuries, or they're not going to go out to the movies as much, right? Because more of their income is going to be going to putting gas in their car and heating their houses, right? So, those things factor in. Defense companies could start to do better if it becomes more of an escalating war where other nations get involved. And so, depending on how long it goes on, there are ripple effects. Now, I thought it was interesting because this week, over the past couple of weeks, the American market, the U.S. stock market, everything's been about the Fed and raising interest rates. Well, now, part of the rally that you saw on Thursday and Friday was the expectation that the Fed is not going to be able to raise interest rates as fast, because it's hard to raise interest rates when you have chaos happening globally, especially with a war. And wars also have the kind of effect of dampening consumer spending, because it's hard to go out and spend a bunch of money when you're seeing wars and families and people being impacted on TV or the news, and you don't know if your country's going to get pulled into it. So wars tend to naturally, behaviorally, have people, save more money. And so if that happens, then inflation would come down naturally and the Fed wouldn't have to raise interest rates up as much. So I know that's a lot to think about. And it's really an unknown at this point. It's really hard to know if that's going to happen. How long does this go on? So that's why, with the lessons that I talked about today, doing the limit orders and thinking about just kind of slowly increasing your positions or getting into new positions, you got to be a little patient. You got to be willing to sit on your hands a little bit. And really, you have to be able to think long term. So those are the, just some of the things that you're going to need to be thinking about financially when it comes to trying to invest in this market. So I hope that's helpful. Also, kind of the Berkshire Hathaway deal. If you haven't watched on YouTube the Warren Buffett documentary that HBO did a couple years ago, you need to do that. You need to go and just give yourself the history lesson of how Warren Buffett became Warren Buffett. I think that's actually the name of it, Becoming Warren Buffett. But you can find it on YouTube and you can watch the whole thing for free. You most definitely need to do that. And then just kind of educate yourself on that and how all that came together. It's definitely a very interesting story. Also, just to let you know, for those of you who listen to this live weekly, I'm going to be traveling quite a bit over the next 2 weeks. I'm going to New Orleans this week and then Denver. And so I'll try to do as many episodes or do an episode if I can. But I was a guest this past week on the Free Retiree podcast show. And so I went over the most common investment biases that impact investor behavior. And so if you haven't listened to that or want, if you want to hear me, there's a place where you can go see that. So that dropped. They put that out sometime this week. So if you want, you can go give that a listen. It does a pretty good job, I think, of just laying out the common mistakes that we make, the mental mistakes that we make. So, but as always, I appreciate your time. I hope that you found value in this. And as always, don't mistake activity for achievement. And I will talk to you soon. Thanks again, everybody.